Germany's older generation is retiring, but there aren't enough young people entering the workforce to support their pensions. Germany has a social security system called Sozialversicherung, which includes programs like health insurance, pension insurance, and unemployment insurance. These programs are funded through contributions from employees, employers, and the government. The pension system in Germany was established in 1899 and operates on an intergenerational contract. This means that the pensions of current employees are paid using the contributions of the currently employed. However, the ratio of workers to pensioners has decreased over time. In the 1960s, there were 6 workers for every pensioner, but now it's only 2 and getting worse. The aging population is putting a strain on Germany's retirement fund. Over 20% of the population is over 65, and by 2060, it's estimated that more than 1/3 of the people will be in that age group. The government spends a significant amount of money, 127 billion euro in 2024, to support the pension system. This amount is expected to nearly double by 2050, which poses challenges considering other high expenditures like defense. The issue of pensions is a hot topic in Germany because pensioners make up a significant and growing group of voters. The country has a mandatory public pension scheme for employees, while the self-employed can choose to pay into the state system or rely on private insurance. And civil servants are exempt from paying contributions to the pension insurance. Together, these two groups represent about 12% of the working population. By the way, if you're new to the channel, my name is Essen, and on this channel we discuss business, investing, and personal finance in Germany. The amount an employee receives from the pension insurance when they retire depends on the amounts they have paid in. It is based on their salary and the duration of their payments. Half of the payments come from the insured person and half from their employer. People with higher incomes receive a higher pension than those with lower incomes. Pensions are paid out as old age pensions, widow's pensions, or in the event of reduced earning capacity. To receive a pension, there is a minimum period of insurance and an application requirement. Civil servants do not contribute to the pension insurance. Their retirement benefits are paid by the state. Employees contribute 18.6% of their gross monthly salary to the state retirement fund, with both the employee and the employer paying half. The monthly contributions cannot exceed 1,404 euros and 30 cents. The government expects the contributions rate to increase to 20% by 2028 and up to 22.3% by 2035, where it will likely remain till 2045. The current pension level, which is the amount paid to retirees each month, is 48% of the average monthly salary in Germany. The federal government wants to guarantee this percentage in law until 2040 with a level protection clause. Please hit the like button if you're getting value from this video and consider subscribing. In 2023, the average monthly pension for old age in Germany was 1,550 euro, according to the German pension insurance. However, Germany's workforce is facing a challenge in sustaining its state retirement fund. Over 20% of the population is now over 65, and this number is rapidly growing. By 2060, it is projected to be more than 1 in 3. This situation is not unexpected. In 1986, then Labour Minister Norbert Blum from the conservative Christian Democratic Union (CDU) famously stated, "The pensions are safe," in response to concerns about the system's collapse. The difference now is that the long-feared scenario is starting to unfold. The challenge of supporting current retirees and the increasing number of baby boomers entering retirement. Additionally, this large demographic will require financial support for a longer period. A man retiring at the age 65 can expect to live an average of 14 more years, and a woman of the same age is expected to live an average of 19 more years. This is a significant increase compared to 1970, where the figures were 2 and 8 years respectively. Experts warn that even with immigration, Germany's workforce could decrease by 2 to 10 million by 2060, according to Germany's Federal Statistical Office. As for proposed solutions, what plans are being considered to address these issues? Raising the retirement age is a recurring proposal. Germany is already increasing its retirement age from 65 to 67 by 2029. A panel of advisors to the Labour Ministry suggested raising the retirement age to 69, which has caused controversy. The Left Party's co-chair criticized the proposal as antisocial, citing data that showed a higher mortality rate before the age of 69. The Parliamentary Committee for Senior Citizens also criticized the proposal, expressing concerns about the older workforce reaching retirement. A survey found that retirement policy would influence the voters of many young respondents. However, older voters who outnumber the younger ones may have different views on retirement, including everyone in the pension system, including civil servants and self-employment is another reform proposed to stabilize the system. Some suggest redefining the purpose of retirement provision. The goal would be to ensure a reasonably good standard of living after a fulfilling career. The suggested pension level would be 15 to 20% above the sustenance level, with the rest of the provisions being the individual's responsibility. In this case, lower pension insurance contributions would give people more flexibility to save for their own retirement. What if state pension is not enough? According to German pension insurance, 61% of pensioners receive less than 1,200 euros net per month from their state pension. 1 in 3 pensioners receives less than 750 euros net. Many women in Germany have lower pensions or no pensions at all. This is because they worked in low-paid jobs or took time off to be stay-at-home mothers and wives. Returning to work after many years is difficult, and for many, the pension is not sufficient to cover expenses. They either work additional jobs to supplement their pension or rely on state welfare benefits. To encourage private retirement plans, the government offered tax breaks starting in the early 2000s. The Riester retirement plan is a popular example but faced challenges due to low interest rates and high cost structures, leaving little money for beneficiaries. Periods of child rearing, education, unemployment, or illness also count towards pension eligibility, in addition to contributory employment. German law requires compulsory social insurance for all employees in Germany. Seasonal workers are generally required to pay social security contributions except for those engaging in minor, short-term employment lasting up to 3 months within a calendar year. In most cases, the obligation to have insurance for employment is based on the regulations of the country where the work is performed, even when considering European and treaty laws. However, there are certain exceptions where an employer sends an employee to Germany for a limited period or an exception agreement is made. In such cases, the regulations of the sending state continue to apply, and no social security contributions need to be paid in Germany. The same applies to employees who are sent to Germany from a foreign country by their employer without a contract for a limited period. If the activity is subject to insurance, it results in mandatory German contribution periods. Whether a pension can be paid depends on factors such as the number of months of insurance completed in Germany. Normally, a standard old age pension is granted once the general waiting period of 5 years is fulfilled. If the waiting period is not met, no pension can be given, but there is usually a right to reimbursements of contributions. If the insured person has accumulated insurance periods in other EU member states or agreement states, those periods can be considered along with the German periods to meet the requirements for a pension. The periods are added together, but generally a minimum period of 1 year of insurance in Germany is required to be eligible for a pension. If the insurance in Germany lasts for a shorter period, the other member state's insurance provider will compensate for the German periods and the entitlement to German pension insurance will cease. In most cases, expats do not receive a high amount of pension if they come to Germany at an older age. This puts them at a disadvantage. Here, looking into private pension programs with tax benefits can definitely help out, which I discuss in this video. Another option for expats could be retirement planning using stock investing, which I discuss in this video. So thanks for watching, bleib gesund, and I'll see you in either of these 2 videos.